Walmart's latest crisis isn't just about price hikes, it's exposing a deep vulnerability in the US economy. And guess who's quietly preparing to take advantage? Canada. Trump's administration imposed tariffs up to 125% on some Chinese imports, later reduced to 30% under a temporary truce. Walmart felt the blow immediately. The company sources about 1/3 of its merchandise from overseas, and of those imports, roughly 60% come from China. That means a wide range of products: electronics, clothing, toys, even groceries like bananas, avocados, coffee, and roses are now exposed to higher costs. CFO John David Rainey didn't mince words when speaking to CNBC. These tariffs are inflationary for customers. In plain English, prices are going up and fast. By late May 2025, the effects were everywhere. Toys took the first hit. About 80% of toys sold in the US come from China, and the price spikes were immediate. Research showed a Barbie doll with a swimsuit at Target jumped 42.9% in mid-April. Electronics followed. Even basic groceries weren't safe, with Walmart's CEO Doug McMillon naming specific categories that would see increases. The timing couldn't be worse for American families. Finance, monthly, calculated that the average U.S. household will spend $4,900 more per year just to keep up with these tariff-driven price hikes. Walmart tried to push back. The company asked Chinese suppliers for price reductions of up to 10% to help offset the tariffs. That move didn't land well. Chinese authorities called Walmart's demands unfair, and negotiations stalled. Walmart is now stuck between rising costs and the reality that they can't simply absorb them, despite claims from the White House that companies would. Rainey's talk of strategic shifts sounds bland, but retail analysts translate that as fewer product choices, possible store closures, and a shrinking workforce. Target, Dollar Tree, and other major chains are raising prices too. Consumer frustration is growing, with shoppers noticing emptier shelves and higher bills on everyday items. The logic behind these tariffs was to pressure China. Instead, the pain lands squarely on American consumers. Walmart's supply chain is deeply tied to Chinese manufacturing, and moving production to places like Vietnam or India isn't something that happens overnight. Even with efforts to diversify, it will take years to untangle. In the meantime, prices keep climbing and inventory runs thin. As US retailers scramble to manage shortages and rising costs, the landscape is starting to shift. The disruptions aren't just creating headaches for American shoppers, they're opening up opportunities elsewhere. Canadian retailers are seeing a wave of American shoppers looking for alternatives to the price hikes and shortages at home. Loblaws and Canadian Tire have both reported a spike in cross-border interest. Customers are reaching out, not just about prices, but about delivery options and how to take advantage of shopping in Canada. The pattern is clear. As US stores struggle, Canadian retailers are actively positioning themselves to capture the business. Amazon Canada is moving quickly to meet this demand. The company has ramped up its fulfillment network near the border, targeting US consumers frustrated by delivery delays and higher prices from American retailers. With the same products and often lower prices, Amazon Canada is now offering faster shipping to northern US states. Their data shows a clear uptick in US orders since the tariffs took effect. Chatter Research points to 3 strategies Canadian retailers are using to make the most of the situation. First, they're locking in supply deals with European manufacturers. Canadian Tire, for example, shifted 18% of its orders from US suppliers to Europe almost overnight. This move is about reducing exposure to U.S. supply chain disruptions and keeping costs low. Second, Canadian retailers are expanding their private label offerings. These products help control prices and keep shelves stocked when branded imports are hit by tariffs. Third, they're doubling down on loyalty programs. Loblaws is seeing significant growth in loyalty signups in border towns, as shoppers look for ways to maximize savings and benefits. Government policy is backing these moves. The Carney government has fast-tracked trade talks with the EU and Mexico, aiming to diversify supply chains and reduce reliance on U.S. imports. The Large Enterprise Tariff Loan Facility, or LETL, is helping major retailers manage tariff-related costs, while the remission framework provides temporary relief for businesses that rely on U.S. inputs. These measures are designed to keep Canadian retailers competitive and responsive as the landscape shifts. Canadian tire stores near the border are already reporting higher foot traffic, especially for items hit hardest by U.S. tariffs: tools, sporting goods, auto parts. Retailers are focused on maintaining inventory and pricing that undercuts U.S. competitors, drawing in both Canadians and Americans. Analysts say this isn't just a short-term play. The habits forming now, cross-border shopping, online orders from Canada, could stick, especially if U.S. prices remain high. With these changes underway, the stage is set for a much bigger shift in North American retail. The question now is whether Canada can turn this momentum into something permanent. The tipping point for North American retail. Pressure on North American retail is building, and the old balance is starting to shift. The tipping point, it's not just about tariffs, it's about how governments and businesses respond to the new landscape. Canada's Large Enterprise Tariff Loan Facility, launched in March 2025, is a big part of that response. The program gives financial support to large businesses that keep jobs and operations in Canada, with a focus on those adjusting their supply chains away from the U.S. Minister Champagne summed up the approach. Canada is using targeted relief and incentives to make sure supply chains and jobs stay north of the border, not just weathering the storm, but trying to seize the moment. Retailers are moving quickly. Companies are reassessing the impact of tariffs on their costs, working to optimize supply chains, and managing inventory with an eye on what's missing from American shelves. They're careful about price hikes, knowing transparency is key when customers are looking for alternatives. Canadian stores are stocking products that Americans can't find at home, things like power tools, auto parts, and certain foods that have become scarce or expensive south of the border. These decisions aren't just about short-term profits, they're about building habits that could last well beyond the current trade fight. Government moves are coming in fast. The Carney government is pushing to attract U.S. distribution centers to Canada, seeing a window to lock in new business while American retailers are distracted. At the same time, Canada is in early talks to expand trade with the EU and Mexico. The aim is to diversify supply chains and reduce reliance on both the U.S. and China. There's also a temporary lift on some counter tariffs for U.S. inputs, 6 months of breathing room for Canadian businesses that still need American goods to keep shelves stocked. But there are real limits. Analysts point out that Canada's ports, highways, and warehouses may not be ready for a massive influx of goods and business. The expansion of the Port of Montreal is underway, but the country's infrastructure has to catch up to this new demand. If Canada can't move fast enough, some of the opportunity could slip away. Retail job growth is strong, driven by logistics and supply chain roles, but there's still a question of whether the system can keep up with the pace of change. All of this is happening as US retailers struggle under the weight of tariffs and supply chain chaos. Canadian businesses aren't just reacting, they're positioning themselves for a bigger role in North American retail. The question isn't just about who wins the next quarter, it's about who controls the supply chains that shape what ends up on store shelves and at what price. This is the new front line in the trade war, and the fallout is only starting to become clear. What's clear now is that tariffs have turned supply chains into a strategic asset. Canada's government stepped in with relief programs like the LETL and the remission framework, aiming to keep jobs and supply chains at home. But this advantage won't last on its own. Ottawa faces a real choice: invest in infrastructure and secure new trade deals, or risk letting this window close. Port expansions and workforce gaps take time to fix. The next steps will decide if Canada becomes a lasting retail hub or if this is just a temporary surge. Tell me what you think. Will Canada's policy moves be enough to lock in these gains? Drop your thoughts below.